and the businesses that you work in as a consultant really are just a vehicle to help you achieve the quality of life you desire and the income you need to support that vision. And I know this can sound very basic, but I do believe in all of the consulting that I do on the financial side that everything comes down to this core value. So I help my clients determine what's the most important to them. You know, it sounds very simple when someone says they want to make as much money as possible. And sometimes that's true, but I find as I get to know my clients that oftentimes quality of life is much more important to them. So they would rather bring in an associate and make less money at some point because they simply want time. In fact, I talked to one of my clients today who actually has decided he'd like to run for political office in the state of Georgia, and he just doesn't have enough time to run his pediatric practice and also run for office. He had someone that was an associate that was helping him part-time, and now that's not working out well. So we realized today that we can help him free up more time by helping him more with his own finances and recording everything for him and paying his bills, and then getting the right associate in there because he's realized he needs to take less money right now because he has this bigger vision of creating a better quality of life for Georgians, and he really wants to make sure he's got the time to make that happen. So I think it's important for your client or you to determine how much money you really need and exactly what kind of business you want to be growing. And I'm skipping through some slides here, but you know, I do have clients who really want to own Ferraris. They want to be traveling all the time. They want to have a big lifestyle. And so we do then create the type practice to help them create enough revenue to be able to do that. I have other clients who decide they don't want to save anything for retirement. Their primary goal is to live in the here and now with their kids. They just want to have a nice house in the country, and they adopt kids and have a large family, and they just want to enjoy life in real time. So everybody has different goals, and so my role as a CPA is to not only do tax returns and bookkeeping, but primarily to figure out what are the client's long-term goals and short-term goals, and how are we going to use tax strategies to help them really take charge of their life and not feel like they're waking up one day only to have worked for 30 years and really have nothing to show for it. So some of the topics that I wanted to cover this evening are the top topics that we're talking about right now for 2017 as we help our clients. We work with about 300 dental practices on a monthly basis, and we work with every possible business model you can imagine except for corporate dentistry. And so through that process, I've come to determine that there are some key aspects of the business that the dentist really needs to be able to run well. So some of the topics we're going to talk about this evening are ways to protect your client and yourself from paying extra taxes if you don't have to. Protecting some income by shifting it to family members. Really protecting your cash flow by also determining what is the legal entity you should be using. That does change your taxes. Also, a big tax strategy right now, especially in the transition world and now that people are growing more, is doing cost segregation studies to create more cash. And then also we help our clients build their cash flow and build their retirement savings. So these are some of the core topics that I wanted you to at least be aware of that we're talking about right now. Because, you know, as you know, a successful dental practice is often like a three-legged stool. We have one leg that is the production that they do, and that's oftentimes what we focus on a lot in consulting. And then there's also the sales and marketing leg. We certainly have to have new patients coming in the door and be able to make sure they understand the treatment that they really need. And then the third leg is the business and finance leg. And I found that in business and finance, most dentists really think of that as being accounting and doing a tax return and doing bookkeeping. But if that was all that they did related to business and finance for their business, that leg of the stool would be too short, and then the stool would topple over. We would not have the most successful, profitable dental practice. So I have found that the most successful dentists really look at using a CPA and a financial advisor to be the CFO of their practice, to really help them make the chief financial decisions that have to be made and really look ahead in a proactive way for what needs they have for cash and to make sure that they're always achieving their goals. because really most dentists do not feel very comfortable being in that CFO role, but they do know that they need to hire someone to help them. So I feel that if your business is a vehicle to help you achieve the quality of life you desire and the income you need to support that, then we've got to build the dream car. And as I mentioned earlier, each person's dream car is going to be a little bit different. But I want to talk this evening about ways in which you can better understand sometimes what it is you're looking at in someone's practice, or to know to ask some questions if they don't know what they're looking at in their own business, and then also help you with your own financial life as well. I hope that you can take away at least one or two ideas from this evening that you can apply in your own business. So most CPAs talk about taxable income because they're filling out a tax return, so they're talking about how much income the client is going to be taxed on. Well, I'm here to share with you that frankly that is not the most important number. The most important number is the cash flow of the practice and how much cash the practice is making, because it's going to be the flow of cash that's going to support your client's business and also building their long-term wealth. Most CPAs don't talk about cash flow because it has nothing to do with filling out a tax return. It really has to do with the profitability and success of the business. But because I'm a business owner myself, I know that cash is most important to me. So as long as the client that you're working with, went too far, can trust that their CPA knows how to calculate their taxable income, then they really should be focusing on how much cash did they make during the month, or how much cash did they lose during the month and during the year. So I do spend a lot of time teaching my clients that cash flow is the net cash that they are left over with. It's not the gross. So it's not the fees that were collected, but we need to know how much cash do we have left over after paying all the overhead, after paying the associate, after paying some of those expenses that are more questionable in nature, things like personal bills that the doctor may have that have been paid through the practice, or distributions that the doctor took out. Those expenses really add up, and oftentimes they don't show up on the profit and loss statement because it's not a deductible item on their business. A lot of times clients will ask me where the cash is going, because I come to them telling them they have a higher net taxable income number than they feel they have cash in the bank. And I can tell you that oftentimes the answer is that they have a lot of debt they're paying back, or they're taking out a lot of distributions. So with debt, when they're paying back their loans, that is using up cash to make that note payment, but we only get a tax deduction for the interest portion of that note payment. And so that's why their taxable income will be higher than the cash in the bank, because they had to spend more cash than they got a tax deduction for. And distributions work the same way. So oftentimes you'll find that your dentist client really has no idea where the cash is going, because you're looking at the overhead that you've calculated, and you know that they're spending more cash than the overhead that is showing on their profit and loss statement. So I would then encourage you to look at the balance sheet and look at those distributions. Usually they're coded in the equity section, and so when the doctor is taking money out or having personal bills paid on his or her behalf, that's using up cash, but we're not allowed to take a tax deduction for it, so it would not have shown up in that profit and loss statement or in your typical overhead. I won't go through all these numbers since we're running a little bit behind this evening, but I wanted you to get an idea of the concept that your client really needs to understand where cash is going. And this happens in your business too. You know, oftentimes you're faced with the decision of deciding if one of your expenses is personal in nature or is it going to be business in nature. Of course, we like business tax deductions because that gives us a tax deduction, so we pay less in taxes. But that tax deduction does not mean that it's a free expense. So for example, let's think of a continuing ed trip that you're going to take. Let's say you're going to go to the ADMC meeting, for example. We could either choose to call that a personal expense and not get a tax deduction for it. Let's suppose the trip was a big one. It was $10,000. Or we could choose to call it a business expense because in this case, in reality, you are going to be doing business. You're going to be talking with other colleagues, and you're going to be learning while you're there. So if we call it a business expense to go to the ADMC meeting, we're going to put that on your tax return as a tax deduction. And so what that does is that reduces your taxable income by the $10,000. It does not save $10,000 in taxes. It actually just saves the $10,000 in taxable income. So assuming you're in the 40% tax bracket, if we combine federal and state taxes, then that means you've saved $4,000 in taxes. So your after-tax cost was only $6,000 compared to the $10,000, but it wasn't free. So tax deductions are good because it does create more cash for you, but it doesn't mean that it's actually a free item. So this is something a lot of times dentists really forget about. So cash flow is going to be the most important number for your clients, but it's the one that's most rarely given. It can be difficult to calculate the right cash flow because we've got to combine what are the typical financial statements that you would see, the balance sheet and the profit and loss statement. Well, most of my successful clients have also decided to amp up their savings and really make sure that one day they're working because they choose to, but not because they have to. And one of the ways to do that is with retirement plan contributions. And this is a really hot topic right now because about 30% of dentists save for retirement using some type of retirement plan. The numbers are shockingly low. And when I'm looking at potential clients that want to hire us, almost always I'm finding that they are not maximizing the amount of money they could put into their retirement plan. They really don't know what type of retirement plan to use, and they really don't know what the maximum amount is they can put in. Frankly, one of the reasons why I see this is because oftentimes they're working with someone they think is a financial advisor, but it's really someone just trying to sell them insurance. They're not really wanting them to be invested in the best retirement plan. They're just wanting to get their assets under management. So there are different types of retirement plans to use. And these, again, would also apply to you in many circumstances. And really, there's a progression. So we normally start off with an IRA. If someone can only put in, $5,500 a year, they can do a traditional IRA. Then they would graduate oftentimes to a simple plan, or maybe a SEP plan. A SEP is also an IRA, and we'll talk about this more specifically in a minute. And then they would graduate to a 401k plan, or even possibly a combination plan where you can put even more money in for retirement. So even if you don't remember any of the details from this evening, there are just a few top tips I'd like for you to just be aware of related to retirement plans. Because again, when you go into your clients' offices, you're helping them build their business and make it more profitable. So you're creating more cash for them, which honestly is creating more taxes for them. So when they work with you as a consultant, I see it over and over again. We're increasing the profitability 25 to 30%. That now is creating a tax problem for them because they're not expecting that big growth, and they have a hard time conceptualizing how much more they're going to have to pay in taxes. So they need someone like a dental CPA to help them proactively plan ahead and start doing tax projections now in the middle of the year. We're starting our mid-year tax meetings and projections in about 3 weeks. So they need someone to project out what would the tax effect be if they do increase their income as much as you're projecting, and then how are they going to solve that tax problem? One of the best ways to solve it is by using a retirement plan and putting a larger contribution into the retirement plan. So like I mentioned, less than 30% of dentists are actually saving money through a retirement plan. One thing to know is they do need to have a large W-2 as an employee of their corporation, if they're incorporated, in order to maximize the retirement plan contribution. So for this year, that's $270,000. I mention this because you'll hear about people saying they're using an S corporation to purposely take out more distributions than they do wages. And we do want to do that to some degree, but what the dentist usually doesn't realize is that if they want to maximize the retirement contribution, they have to have a W-2 of $270,000 or more, and then we can play games with money after that. They can contribute more money to the retirement plan if they're over the age of 50, so they can catch up. With a 401k plan, many doctors do not realize that they can put in the deferral from their paycheck, and they can also put in a profit-sharing contribution. And that's what many doctors are missing. Many of them are only doing the deferral, thinking that they're maximizing the use of the retirement plan, but they're not using the profit-sharing component. So they're leaving another $40,000 to sometimes $50,000 on the table, which is a huge tax deduction to have left on the table. And dentists are starting to hear more and more about the combination profit-sharing defined benefit plans. With those plans, my clients can put in usually up to about $250,000 into one of these plans. Oftentimes, this is an excellent way for them to catch up if they haven't been saving enough for retirement. And oftentimes, we'll start doing this just a few years before they're going to sell the practice, so that they can now use this for about 5 years to really maximize their savings for retirement. And the last thing to know is that sometimes we can exclude staff from the retirement contributions. So just know in the back of your mind it could be possible. It's a little complicated to do that, and the ways we can manage that the best are with a SEP IRA plan. So I do have some limits on here for you to be able to be aware of, and I'm happy to share this information if you would like to email me. My email address is katew@thewillefordgroup.com, and I'll share that again at the end, and I'm happy to share any of this information with you. I would say the main thing to know this evening is that the SEP IRA is the type of plan that I like for young dentists to use when they're in business for the first 3 years of their business. Most CPAs and advisors do not advise dentists about the SEP IRA because there is no administration cost. So the advisor is not getting paid anything to have them use the SEP IRA. So that's oftentimes why it's very rare for anyone to talk about this. But if you're working with some startup practices, they can actually put in up to 25% of their income, up to $54,000 this year, into an IRA, and they do not have to include anything for the staff for the first 3 years that the staff person is an employee. So this is a phenomenal tax deduction, and I know it can be hard to imagine that a doctor that young might be able to put in $50,000 into savings, but I do have clients that do it. They make it a top priority. So that's something important to know, and I teach at 5 of the dental schools around the country, and I talk about that concept a lot, and many of the doctors, when they're coming out of school, are really wanting to save as much as they can. With 401k plans, that's probably the type plan that you're going to run across the most. The 401k plans are excellent because we can put in a contribution for the staff. The doctor can put in over $50,000 a year into the plan and also put in the 401k deferral as well. They have options to decide if they want that 401k deferral to be treated as a Roth contribution or a traditional contribution. And so again, we get a very large tax deduction. And so a 401k plan is going to be typically the ideal plan for someone who has been in practice for over 5 years and really does have, I would say, between $30,000 and $70,000 to put into a retirement plan. If someone can put in more than $70,000 a year consistently, I would say has that cash for a good 3 to 5 years coming up ahead of them, they project, then that's when they would do the combination plan that we talked about. So the administration of 401k plans really isn't as expensive as doctors think. You'll oftentimes hear dentists say that they don't want to use a 401k plan because it's so expensive. Well, I want you to know behind the scenes it's not as expensive as they think. Typically, it's going to cost between $2,500 to $3,000 a year to administer a 401k plan, which includes doing all of the tax returns, all the certificates, calculating all the amounts of how much money can go in for each employee. But here's the key, is that they get a tax deduction for that. So they're getting a 40% discount in many cases because a lot of our clients are in those top tax brackets. And so it's really only costing them actual cash of 60% of whatever the administrator is quoting them. And in addition to that, they're getting the tax deduction for all the money that they just put in. So usually I find they're saving far more in taxes than they are by the cost of the plan or even the cost of putting in money for the staff. So I definitely recommend that you let them know that retirement plan options are out there, and dental-specific advisors can help them analyze that. Let's skip over the cost segregation this evening, except just to mention to you that cost segregation is an excellent tax deduction to use if you have a client who's doing a large build-out, even just renovating their building, or is actually building a building. So in these situations, if your client is going to be spending over $200,000 on some kind of renovation or build-out, not including equipment, then you should recommend to them to talk to a dental CPA about cost segregation studies. It's a way for us to take a faster tax deduction for them, which creates more cash in the first few years of the project, which will help them fund the project. And so usually we're saving clients between $50,000 to $150,000 in cash in year one on these types of build-outs. So cost segregation studies usually involve an engineer, and so it is more complex than just having a CPA calculate a few numbers for them, but it's well worth it if they're doing a larger build-out. So just be aware that that is something that we're talking about right now, because we really are seeing a lot of practices now moving locations now that the economy has improved and actually building that dream building that they've been thinking about doing for a long time. Okay, so we've talked about cash flow and we've talked about retirement and briefly touched on that topic of cost segregation. With our time constraints this evening, I do want to move on to really talk about the new tax law changes, because that's something that is in flux right now. We were hoping, of course, that we would have the new tax laws this year by now. The administration, as you know, has been talking about it for quite a long time. But I wanted to share with you what I think now may be coming, hopefully by the end of September. I was reading earlier this week that they initially said they would have some new figures for us in the fall. Now they've backed that back a little bit to say September. But the idea is that they're hoping to propose something before they take recess in August. And it sounds like the Republicans are then going to aim for September 1st as really having a solidified front as to exactly what they're going to propose. So I wanted to tell you a little bit about where we think things are headed, and these are some of the assumptions I'm using in the tax projections that we're starting to do with our clients right now. So the corporate taxes, we are expecting to see that decrease. So as it stands right now, C corporations are the ones that pay a direct corporate tax. S corporations do not, because the income that the practice generates flows through to the owner on his or her personal tax return. So the big news here is that the tax rates would go down from 35% to 15%. Initially, we were not sure if this would affect S corporations. We now believe that it will, but it's going to be in a unique way. Because of the fact that owners of S corporations do take out payroll as part of their income and distributions, it appears what they're going to try to do is only tax them at 15% for all of the net income of the business, regardless of how it's taken out. We're really looking forward to seeing specifics on this, because it's complicated to implement something like that with S corporations, but it does appear that that's a topic they're considering. They'll repeal the investment tax. This primarily affects clients who have large amounts of stock sales or have a building that they don't own 100% of the building, or maybe where they own 100% but they're renting part of it to someone else. The investment tax was affecting them. And the short-term capital gains, those tax rates should be reduced. Right now, if you sell a stock, let's say within the same year that you purchased it, you're going to pay short-term capital gains on that growth at ordinary income tax rates. What will happen now is you would be taxed at the lower tax rates we'll talk about in a minute, effectively reducing the short-term capital gains tax rate. And probably repealing the estate tax, which only affects 1% or less of the population, but it does affect some of our clients. On the personal tax side, we are expecting tax rates to decrease. The highest tax rate right now that many dentists fall in is 39.6% on the federal level. That would be reduced to 35%. This is a figure that has remained pretty consistent through the election cycle and the current conversation, so I do expect that that will happen. Also, they will be reducing the tax brackets probably from the 7 tax brackets we have now to a condensed 3 tax brackets. These brackets tend to fluctuate in conversation, but right now it's sounding like it may be 10%, 25%, and 35%. They'll change the standard deduction. The primary confusion right now and a lot of the conversation is surrounding eliminating the personal tax deductions. So on your tax return, you have a Schedule A where you are taking tax deductions for some types of retirement contributions, your home mortgage interest, charitable contributions, the state taxes that you pay, and other items. So what they're talking about doing is possibly eliminating all of those deductions except for the retirement contribution, possibly the home mortgage interest, and charitable contributions. But even the home mortgage interest is part of the conversation still. The main thing to be aware of here that more and more people are starting to realize is that in states where you have a high state tax, such as California and New York, when you take away that state tax deduction, that is going to increase someone's federal taxes because they're used to receiving a large state tax deduction that they may be losing. So just know in the back of your mind, that's really one of the hot topics right now. And they're talking about repealing the alternative minimum tax. That's always been a confusing tax, but it does affect many dentists who, again, have stock sales or who have practice sales, who have large mortgage interest deductions. And so if they repealed the alternative minimum tax, that would certainly simplify the taxes for someone really making over $1 million of income for sure, but probably even lower than that. Could go down quite a few $100,000 by who that would affect given their specific situation. So you might be aware about this is that there are tax changes coming and it's really a little unknown at this point. So make sure that you're planning ahead for your own tax situation and really looking at some projections for best case scenario, worst case scenario, and encouraging your clients to do the same. You know, most CPAs are hired by the client to do an annual tax return, and the dentist doesn't really realize that they could be planning in advance. There's no reason to have tax surprises. Many dentists don't realize that a good dental CPA can project these possibilities for them and projects them far in advance and make sure they don't have big surprises. Let's talk about shifting income over to other family members because this would affect you possibly in your own business as well as your clients. One of the ways that we are saving money for our clients and creating cash for them is shifting some of their taxable income over to kids and grandkids. This is a way to really create more cash because we're taking a tax deduction for paying the children or the grandchildren, and they are now going to be taxed on that income at their tax bracket instead of the adults. So the idea is that we can pay the kids whatever we would pay a non-family member for the same type job. We do recommend that as a business owner, you keep a job description of exactly what the child is doing. Keep a timesheet as well. Even at a minimum, just record in Excel. Create a spreadsheet of how many hours they've worked and what you're paying them per hour. And then they need to be paid a W-2, just like a regular employee would be. They do not get paid as an independent contractor. By doing this, we're then creating a tax deduction for the business owner. We're now shifting income into the child's tax bracket, which is oftentimes 0. So usually that means if we're going to pay a child, let's say, for example, $6,000 a year, that the business owner is going to save at least $2,400 in taxes that year, which is real cash that is staying in that business owner's pocket. What's very exciting about this, too, is it now gives us a way to save for the future of the child. So if they are paid as an employee, receiving a W-2, they now have earned income, which is very unique for a young child. because they have earned income, they can now contribute to a Roth IRA. And that money will grow tax-free for them for forever. Some of the wealthier dentists are creating cash by actually passing down these Roth IRA accounts from one generation to the next. And so you can imagine that money is growing exponentially and they're never having to pay taxes on it. So it's an exciting way to be able to shift some income to other family members and create cash in the process. Well, one of the more boring aspects of owning a business is certainly checking your brakes and making sure you've got the right legal entity in the first place. And, we're seeing right now many changes in legal entities because we really have changes in the type of ownership of dental practices. I've been doing this, over 22 years, and through all those years, we have seen many changes in the type business models that are the most successful and the way they're being run. Right now, we're definitely seeing an increase in having multiple partners or in having partnership changes. And I would say that's where this gets the most complicated because it is very easy to create tax problems if you sell 50% or more of the partnership without planning ahead, or if you sell the stock of a corporation instead of the assets of a corporation. In addition, of course, we are seeing DSOs and DMOs, and so we do work in that area as well, helping you set up the right entity structure so that you can have non-dentist business owners, but in such a way that everyone, again, is paying the least amount in taxes that they legally have to pay. So if you would just have one takeaway this evening, it would be that you never want to be a sole proprietor as a dental practice owner these days. You're going to save the most in taxes if you are set up as an S corporation. Now, sometimes that means that you're going to find a doctor who has been set up as an LLC as being taxed as an S corporation. In your case as a consultant, you would typically save more in taxes as well if you're an S corporation. If you're earning over, say, $175,000 or so in net income, it's possible being a sole proprietor or an LLC will work for you, but it's just a calculation that needs to be run because if you're a sole proprietor or an LLC, you are paying self-employment taxes, and that can be a very expensive tax to pay. But if you're making over $175,000 or so in income, oftentimes we can avoid some of that self-employment tax and use a corporation to do that. I know we're getting close to the end of our time here. We wanted to be able to see if anyone had any questions. I think with our technology issues this evening, unfortunately, I don't think we can see questions being typed in or hear questions that are being asked, but I will make sure that you've got my email address to be able to ask me any questions afterwards. And I would really encourage you to think about your own business and really think about where are you starting right now in your financial life and where do you want to go? How much money do you want to make? How much money do you need to make? What type of quality of life do you want to have? And then make sure that you build your business as your dream car. Build it in such a way that you can have that quality of life and income that you want to have. And here's my contact information, so please contact me with any questions that you have. I'm always happy to help answer any questions for your clients as well. If you have a quick question you want to run past me for one of your own clients, I'm happy to do it. Or, of course, if there's anything else I can do to help them, please let me know. Thank you so much for your time this evening. I apologize for our technical difficulties and kind of racing through a little bit of this just to keep you guys on schedule this evening because I know it's getting late on the East Coast. But if there's anything I can do, just reach out to me. And thank you so much for your time this evening, Nancy, and getting this all set up.
And Kate, thank you so much. I appreciate this. This was an excellent presentation. And to let everybody know that we've recorded this and it will be sent to you. Thank you so much again. We'll see you again on our Wednesday education sessions. Thank you.
Good night, Nancy.
Good night, Kate. Good night, everyone.